How many times have you been faked out of your trades? You thought that we had a market structure shift, yet you entered and we just resulted instantly in a loss. And that is what I want to break down in this video. How to stop getting faked out by using one simple principle. A principle so simple that anyone can apply. And I'm confident that if you take what we talk about in this video in its entirety and you apply that in your charts, the odds of your trading success will increase dramatically. So let's go onto the screen, no more chit chat, and let's talk about how to stop getting faked out. If your charts at the end of the trading session look any way like this, where you take one loss, you take another loss, longing the market, and then you end up missing out on a win because as a good trader that you are, you limit yourself to 2 losses per day, but therefore you missed the third winning trade. There is one concept that is incredibly important, and that is market structure paired with the higher time frame PD array. First, let's talk about what a higher time frame PD array is. So a higher time frame PD array can be an order block such as this down close candle on an uptrend. So an order block is simply all of the down close candles on a bullish market structure. So this was an order block and this was an order block, but obviously we can see that this one, due to its sheer size, is much more relevant than the small order blocks right there on the 1 hour chart. And you can notice how the market went towards the higher time frame PD array, so the 1 hour big order block, and then had the reaction bullish, the reaction that you expected from the charts. Now, a lot of traders get faked out in these sort of positions for one simple reason. And the way you can avoid getting faked out on these moves is by understanding one simple concept, and that is market structure. But not just normal market structure. I want you to think about market structure in terms of multiple time frames. So you want to see what the market structure is on the daily, on the 4 hour, on the 1 hour, on the 15-minute, the 5-minute, and the 1-minute. And why is that? Because the more time frames are aligned with your direction, so let's say the daily is bullish, the 4 hour is bullish, the 1 hour is bullish, 15-minute bullish, 5-minute bullish, then you know that the longs on the 1 minute are going to be very high probability. Yet if we check on these specific trades how all of these charts look, you will see something very, very different. So if we go onto the daily chart, we already have a chart that is kind of range bound, right? I'm even going to put a neutral on the daily chart. Then let's go on to the 4 hour, and we can say that 4 hour market structure is indeed already showing bullishness. So therefore we have daily being neutral and 4 hour being bullish. If we go into the 1 hour chart, we have the daily neutral, 4 hour bullish, 1 hour bullish. But on the 15-minute, this is where we start seeing where this starts to apply. Because yes, we have the daily neutral, 4 hour bullish, 1 hour bullish, but notice how the first 15-minute candle closed very bearish. So let's say that the 15-minute was bearish. And if we go into the 5-minute, notice how there was no signs of bullishness on the 5-minute. So we have daily neutral, 4 hour bullish, 1 hour bullish, 15-minute bearish, 5-minute bearish, and obviously if we go down to the 1 minute, you will see, okay, sometimes it was bullish, but it was getting compressed down by these other time frames such as the 15-minute and the 5-minute. So what could you have done differently? Well, since the daily was neutral, 4 hour was bullish, 1 hour was bullish, but 15-minute and 5-minute were bearish, the way you would increase the probability of this trade playing out is by waiting for the 5-minute to turn bullish. And that is the big secret. It's because when you see that all of a sudden only one time frame isn't aligned, then the probability of the trades that you are taking increases a lot. And so let's quickly go into the 5-minute, and you can see that the 5-minute closed very bullish. So we have move lower, move higher, move lower, and a nice market structure shift. So the 5-minute has now turned bullish, and notice how there was no drawdown and the market went towards your target. The target that you already had for the longest time. And now what I'm about to tell you is going to completely change your trading forever. And that is that when the 1 minute is moving bearish and you notice this bullish push, you will always have to go into the 5-minute and see, am I about to get faked out or not? Because most of the time, when the 5-minute still has a long way to go, these are usually the fake out moves. And then the market continues moving lower, you have the push up, the 5-minute is now bullish, and this is where the real movement happens. But all of this is of no help to you unless you understand this next concept that I'm going to talk about, and that is the higher time frame PD array. So notice how the 5-minute flipped bullish once we hit the big 1-hour order block, the down close candle of this bullish trend. And we can see this happening over and over again. Notice how the market keeps moving bearish until when? Until we hit the very strong bullish fair value gap. And for traders who don't know what a fair value gap is, a fair value gap is just a gap between the first and the third candle of an impulsive move. You can notice that the low of the third candle and the high of the first candle leave a gap. This is what is called a fair value gap. And that's when the market gives you the move that you would want to see and goes towards the extreme, which right there. So you would take profits all the way at the high, because we know we don't target external range liquidity, but that's a topic for a whole nother video. Here's another example of the market having bearish structure. So if we check, the daily chart has now engulfed, which means that this daily candle has completely negated the last bullish candle, creating a short-term bearish trend. So the daily is now bearish. The 4-hour not only created an internal market shift, but it also fully reversed this fair value gap, creating a bearish inverted fair value gap, which is a bullish fair value gap that gets disrespected through a bearish close. So the 1-hour is bearish, the 4-hour is bearish, but notice how for now, the 1-hour is still bullish. So we have the daily being bearish, 4-hour being bearish, 1-hour is short-term bullish, but overall bearish. So what do you want to see for this trade to be high probability given what we've talked about already? Well, you want to see this 1-hour turning bearish, and that is where the high probability trades come in. But let me show you one important thing. Notice how, even though we've seen that the market is bearish, notice these bearish trends. So every single trader that has entered in these shorts has eventually gotten tagged out, even if they put their stop loss above the high. But notice how everything that we've mentioned in this video ties with this exact price action. Once we react from the higher time frame level, where we have a 1-hour fair value gap, we have a 15-minute fair value gap, and then the 15-minute turns bearish and the 1-hour turned bearish. So the daily is bearish, the 4-hour is bearish, the 1-hour is bearish, the 15-minute is bearish. If we go to the 5-minute, it is also bearish. All of a sudden, all of these bearish levels are getting respected, and we see strong displacement out of it. Displacement simply means momentum, and we have a bearish fair value gap. This would be your entry because we have the daily bearish, 4-hour bearish, 1-hour bearish, 15-minute bearish, 5-minute market structure bearish, and the 1-minute is also showing bearishness. So therefore, notice how high probability this trade is. So while traders were trying to trade these levels and they were constantly getting faked out, you waited for market structure to align with your direction and the higher time frame PD array to get hit, and then you had a very high probability trade. And you will see this happening everywhere, especially with 1-hour PD arrays, which is, notice how the market only displaced once we hit the 1-hour level. Same thing here. It only moved once we hit the order block. So market structure is telling you the whole story behind the move, especially when you pair it with the higher time frame level. And so if you want to stop getting tagged out of these moves when the market still still moves in your direction, the best thing you can do is you wait for market structure confirmation. And this is something that we hammer on every single day inside of Funded Trading Blueprint. And this is my mentorship, which if you want to check out, we have limited spots available. But if the second link in the description is working, then you would be able to submit your application. This is what has gotten traders like Elia funded in 50 days and gotten payouts. In just 76 days, getting over $1.3 thousand in payouts. And this in only 76 days. We guarantee that you get funded in 90 days. And if you don't, we have the most insane guarantee this industry has ever seen. So if you want, apply with the second link in the description. So this is how you stop getting faked out of the market and how you will be one step closer to trading profitability. Check the video on screen right now to see exactly how I trade and sign up to Funding Ticks and use code Kimmel in Funding Ticks for the best futures prop firm. Hope you enjoyed. I'll see you in the next one.